On today's show, 3 questions. Number 1, did the Fed do it again? Number 2, is Berkshire in trouble? And number 3, is the Social Security math not mathing? Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
And I'm Rabih.
Yeah, you are, Rabih.
What's up?
Just the two of us. Special show today.
Very special.
Rabih, tell the people why it's a special show. Where are we?
I am in a beautiful Park City in a beautiful hotel room. It's 100 degrees up there, but there's a chimney next to me. Does this ring any bell? We're in a ski resort.
Wait, it only gets it's not 100 up here right now. Is it? What I hit in triple digit in Park City? Let me just double check. Now we're going to check this on the air where we're at. Current temperature 81. Now you're just being dramatic. Okay. You're being dramatic.
I was looking at my car's dashboard driving here, but
it is 100 degrees in Salt Lake, I think, today. So
it is.
Right. But it's about 20 degrees cooler up here in Park City.
But it is beautiful. Matt, why are we in Park City?
Look at us doing this back and forth like we're playing tennis. We are in Park City, Utah for the much anticipated second annual Dentist Money Summit. If you've been listening to the show at all for the last 6 to 8 months, you've probably heard us talking about this at the end of every show and me making my ridiculous connections to the call to action to get you up here to the Dentist Money Summits. If you are listening to this and not here, it is too late. We have held the summit already. But it's amazing. It's so fun up here, and we'll do it again next year, so you still have a chance. Let's jump in, Rabih. Let's talk about, I think, another anticipated piece of news is the Fed was announcing the rates, and you wanted to ask, did they do it again? What do you mean, did the Fed do it again?
Did they get under Trump's skin again? No, I'm just kidding. What
the
I
answer
mean,
is yes.
They always do.
Jay Powell, yes.
But what they did again is that they decide to hold rates steady and not increase or decrease interest rate in that sense. And they did. And the market was kind of expecting it, although there's political pressure on them to cut interest rates. But what is more interesting is the summary of economic projections that they give every single quarter, right? I know there's been lots of news this week, there's a war happening. Politics is all over the news. The Dentist Money Summit is happening, but also
we know that's the biggest thing. There's a war breaking out in the Middle East, but also
there's a
Dentist Money Summit's right up there. Exactly.
So in between these two main events, the Fed had their meeting, So I got the data on what the Fed thinks the economy, unemployment, inflation, and interest rates are going to be like. But I'm starting to notice a certain trend. So I'm going to give you the numbers from their December projections, from their March projections, and now from their June projections. Okay? So let's start with the GDP. For December, they expected GDP in 2025 to be 2.1%. In March, they changed their mind and said, no, we think it's going to be 1.7 for the year. And then in June, just now, they said, oh, we think it's going to be 1.4. So they are just decreasing their expectation of what GDP growth is going to be. It is not a recession. We're still talking about positive numbers for the year, right?
Slowed.
But it is slowing down and it's below the 2% target, which is the target where we attempt to have the GDP growing at. Soft landing, yes, and the airplane is like very slow on the tarmac, it's not moving. That is 1. 2, we got unemployment. In December, they thought unemployment rate would be 4.3% for the year. In March, they increased it to 4.4, and now they increased it to 4.5. Typical recessionary slowdown rhetoric, slowing economic growth and increasing unemployment, right? It's increasing from 4.3 to 4.5 according to their expectations. Then they hit us with the inflation. And let's go with their core PCE inflation. That is the number that they wanted to bring to 2%. That is the one which is their target. In December, they said the year is going to end at 2.5%. And then in March, they said, no, 2.8 instead of 2.5. And now in June, they said it's going to be 3.1. So not only economy is slowing down, unemployment is increasing, but their inflation expectation, the one that they want to bring down to 2%, is increasing to 3.1. Good news?
No,
I don't think so. I don't think so. And to make this worse, a little bit worse, in March, or in December, they were pricing in 2 rate cuts for the year, aka 0.5% drop from the beginning of the year until the end of the year. It means that we are moving from the 4.5 right now. We'll go down to 3.94 type of situation. In March, they did not change their expectations. They were still saying 2 interest rate cuts for the year. And now in June, even with this stagflationary data of higher unemployment, higher inflation expectations, slower real economic growth, they're still saying it's just going to be 2 interest rate cuts. Will they get under Trump's skin with that data? 100%. Because right now, the data is indicating for you that there is a slowdown. You even price in the slowdown into your expectations. But because you're afraid of the inflationary impact of the tariffs, this is what Jerome Powell said in the interview yesterday multiple times. We still haven't seen the full effect of the tariff price increases into economic activity. They are standing put and not decreasing interest rates. And they are saying this puts us in a position where we can act better in the future. The president thinks that's too late. The market mixed views. Some of them think it's going to be too late. But also, if you look at the Fed funds future, the market is pricing in the first cut in September and the second cut in December. If the market thinks the economy is going to be slowing down, they'll price in more than one cut. So the market's still undecided. But there are 2 actually economically viable paths. The path that the Federal Reserve is talking about, let's stay put, let's wait this out another couple of meetings. And there's the administration's perspective that you can't be too late. You have to be a little bit even more forward-looking than that. Which one will prevail? We do not know. But we know that we are heading towards, at some point, a cut in interest rates.
So, Rabih, let me ask you. So the worry, if I'm hearing you correctly, the worry from the Fed is that if they cut rates too soon, inflation it leads to a higher likelihood with the tariffs that inflation would get back out of control, and that's their number one worry.
100%.
It feels like, is it safe to say the Fed is almost taking a bet to say we'd rather risk a recession like that, like they're okay risking a recession, and they're almost kind of just like playing these. It sounds like kind of maybe just playing this like probability game, and they probably have to, in some ways, project out like what's a bigger consequence. Is it safe to say that they're saying we'd rather risk a recession than runaway inflation again?
I would think so, because inflation will take time. Remember back 2 years ago, every time they increase interest rates, we say, oh, it works in lag. It's going to take 18 months.
Yep.
But once the Federal Reserve goes in and cuts interest rates by like 0.5 percentage point immediately, the stock market will rally, bond prices will go up, everyone will go refinance their house, everyone will suddenly have immediately more money to spend.
And then inflation could get out of control
at that point. But if a recession is happening, you can stimulate the economy much faster than if inflation is happening and you want to slow down the economy. You slow it down quickly, but you stimulate it really fast.
Yeah.
That is kind of the dynamic. But something that was very interesting from that meeting, or like while I was watching the press conference, that I was surprised they covered a lot of time on it. Of course, there's the part that the president is not going to renew your term, you're leaving. And I just counted it. It means we still have 7 more meetings for Jerome Powell before we get another Federal Reserve. I know it's a committee decision, but if you get someone who is a little bit more dovish, like the administration is, we might see a different monetary regime going forward. But also, it was a lot about the restructuring that they are doing inside the Federal Reserve. The Federal Reserve is cutting 10% of their workforce, trying to be fiscally responsible, sending a message to Washington that, hey, take a look at your budget, try to be more fiscally responsible. And a lot of worry and concern was, so you're cutting 10%. Are those people not working, or now that you're cutting 10% over a period of time, it's not just happening in one go, they're offering buyouts, etc. Does this mean that either people were not working and you were inefficient, or will that affect the quality of your ability to better monitor the economy? There's been worries that survey providers, those surveys that we look at every single week, whether it was consumer confidence or outstanding claims for unemployment, etc., those survey providers have been reducing their sample sizes. Instead of, surveying tens of thousands of people, they're probably surveying a couple hundreds or 1,000. People are now afraid that there's going to be variability in the data. And if you have a Fed that is data dependent, is that Is that scary? Because
Yeah.
if now it's garbage in, garbage out, the Fed is very data dependent. We're getting new data. Honestly, Jerome Powell acknowledged it, and he said this might make data going forward more volatile. But this
Less
does not
reliable,
mean
yeah.
that we do not have proper mechanisms in place. And honestly, I think from the press conference, this is a better sign than worrying whether we're going to cut 2 or 3 times this year. Peel and press conference really focus on systematic risks that happen in the background that might affect the economy as a whole. So overall, it's a good sign, and we'll just wait. They're going to be meeting in July, and then no meeting in August. They'll have the Jackson Hole Symposium in August, but they'll meet in September. Probably one more meeting without a cut, according to the market, and then they'll cut in September. And Jerome Powell's term ends in May. So I don't know, when people are leaving, they're focused on making sure nothing breaks before they leave, instead of trying to probably do something that is of a big magnitude, but will be a work undone. There's a human aspect over here looking at legacy. So those are the stuff to look at. But did the Fed do it again and not cut interest rates? Yes.
Got it. And then the flip side of this is Trump is pushing hard. He's very vocal about Jerome Powell cutting rates. From his standpoint, you said the word legacy, I think is interesting. Is it safe to say they're just two sides of the same coin, where Trump is worried about a recession, where Jerome Powell is looking at the inflation side of things? I would imagine, just speculating, that if a recession hit during Trump's term, which chances are, just based on data, it's a strong likelihood it could happen. But it feels like, I love that you just used the word legacy, because it feels like maybe Trump's really concerned about that. Like, that's his number one focus, is we can't go into a recession, which is why he's putting so much pressure on Powell to reduce rates or to cut
100%.
rates.
Powell's legacy is that I curbed inflation without putting the economy into a recession. I did a soft landing, that probably the largest one in history. I was there to control what has happened during COVID monetarily on an international scale. And I am known to be independent thinker, like the Fed should be, and, often fights with
and
the
not
president.
succumb to the pressure of
To the president. That is the legacy that he would want to maintain. Trump, on the other hand, we all know what type of legacies he's trying to, just like the strong America first, the president that actually has expanded the power of the executive branch over other branch. Like, that's the type of legacy that he leaves behind, a strong president. And a recession might hurt him. Most of the tweets are indicating that, hey, we need to refinance the federal debt at a lower interest rate. Europe has cut 10 times so far. Why haven't we cut? That is the type of rhetoric the president is following. There is an economic logic to it, because the US is part of an integrated economic system. And if there are other countries with better economic or monetary regimes that support economic systems, money will flow there. So I see the point, but it is also a balance of the risks that the Federal Reserve is worrying about. I think this is, putting the name calling aside, this is a very healthy economic debate between the Federal Reserve and the administration on the proper path. It filters out bad ideas, and hopefully the best idea pushes itself forward.
Yeah, I love that you said outside the name calling. If we could just focus on the ideas, that would be great. Okay. Anything else, Rabih, you want to add to the Fed? And okay, that was a great summary. Number 2, it's funny, before we got on, we were discussing ideas to talk about, and both of us like, did you see the Berkshire Hathaway? You brought it up. I was like, oh, look at the doc. We have it on there. So is Berkshire in trouble? This caught both of our eyes, clearly. Since May 3rd. So that's when Warren Buffett announced his plans to hand over the reins to his incredible legacy, which is Berkshire Hathaway, the company he's built over multiple decades. Since then, the stock, Berkshire Hathaway stock, has dropped double digits. So it's now fallen over 10%. So that is now underperforming the S&P by 15%, which, by the way, Rabih, can we get an S&P watch, please? S&P watch for the year? Where are we at?
Yes, for sure. For the year, we are at, I just had my thing so hold on, since I have it in front of me. Since he announced his retirement, by the way, S&P is up 5.41% and Berkshire is down 10.13%. But if we look year to date, Berkshire is up 7%, where the S&P 500 is up 2.2%.
Okay.
So I think it'll be Berkshire has been outperforming the S&P 500 for a while, so I think it'll be a minute before they start underperforming. If you look at the 3-year chart, S&P 500 cumulatively is up 69 or 70% in a sense, and Berkshire is up 80%. So even over a 3-year period, there's a 10% cumulative outperformance, which is like a 3% per year type of thing.
Got it. Well, it's interesting. So for the details here, Buffett's not actually leaving until the end of the year. So he's actually not, he's going to carry out his duties until December 31st. So it's interesting. This clearly is just showing lack of, I don't know if it's probably not lack of faith of his predecessor. It's more of just like, how do you replace a guy like Warren Buffett? It's probably more of the message is, right? Yeah. So something to look at. I don't know if there's much else to say. This is a short topic, but just something worth noting. And I think maybe the message here is something we've shared a lot. If we look at this as like a core principle of investing of company specific risk.
100%.
And this is something we repeat time and time again, like the fundamental aspect of investing is diversification. And we have countless stories like this of something as stable and as outperforming as Berkshire has been. All of a sudden, the CEO, the legend that is Warren Buffett announces, and then look what happens. The message being, the company specific risk, that specific type of risk can be avoided with proper diversification. Rabih, what else would you add to that, if anything?
This reminds me of the 2 different ways it could go. I don't know if you remember the issue with changing CEOs between Starbucks and Chipotle. You probably would.
Of course, right? I do. Come on.
So a couple of
I track Chipotle more than anything in my life. Not the stock, just the inner workings of the company. Yeah. But really quick side note, Rabih, we talked about the buy one, get one free the other day at Chipotle. You know what it was? I found out it was if you had a tattoo. So I went that night and got a free Chipotle.
I thought you said you went and you got yourself a tattoo that night.
I got a tattoo and then went straight to Chipotle. No, I already had a tattoo, so it worked out great. I got a buy one, get one free. It was perfect. So sorry, go ahead.
So funny. I would not be surprised, honestly, if you come into
go
the
and
office
just get like a little
day.
like tattoo. If I did do that, I'd get a mustache on my finger so I could just pull it up like
that. And it'll say double chicken because that's your go-to order.
Just say double chicken on my finger. Exactly.
Anyway, going back to the stock, the whole CEO shuffling situation did not work out well, right? Between the 2 companies. And that's where we highlight company-specific risk. And probably because the CEO came from a different company, different industry, etc. But another situation that comes to mind, and it's like it could go completely the other way around, is when we lost Steve Jobs and we got Tim Cook instead, right? In Apple. And Tim Cook was able to grow, monetarily speaking, not brand-wise, Apple as a company much larger than what Steve Jobs did. So would it be same philosophy, new blood, something positive? It could be. We hope it would, because Berkshire as a stock price has been, an anchor of what a rational investor should do when the stock market is being irrational.
Yep. Yeah, it's a really good point. I'm glad you brought those examples up, because right now this is just based on, I don't think it's that shocking, to be honest. Maybe it's shocking of the magnitude and the speed and the amount that it's dropped, but I don't think it's that shocking just directionally. What are we smirking?
I'm still laughing on the double chicken part. I'm sorry.
That was good. You're like, I'm still laughing at my own joke. But I don't think directionally it's that crazy to say that there would be a shock or a response to the downside when someone like Warren Buffett, who's literally, I think, probably considered the greatest and like most iconic investor of all time. So I don't think it's that crazy. And I could very well see, to your point, this just being a short-term consequence, selling on the news, and then, long-term, it actually does not have a huge impact. I would imagine that Warren Buffett has probably not had much involvement day-to-day at Berkshire for quite a while. He's still the face of it, but he's got an army of people he's been training that are there, that it's probably going to go business as usual, I would imagine, at this point.
Berkshire is one of the top 10 largest companies in the US on the S&P 500. If you look at it, we will see, I do not expect it to just crash, but if they are doing bad, it means that they're going to be outrun and outperformed by other companies. So instead of taking a bet on it, just make sure it is there, part of your portfolio. It's top 10 stock in the US, but also it's not your whole portfolio. So other winners can carry your wealth.
Yeah. Yeah. And I mean, to that point, if you're properly diversified, let's say worst case scenario, we have a doomsday scenario with Berkshire. Let's say it goes completely under, which we've seen happen with companies its size, or maybe not completely under, but get pulled out of the S&P. Let's say GE comes to mind of a downfall of a great American company that was decades old. If you're properly diversified, that risk is not even close to catastrophic. It's actually a blip on the radar. So that being kind of again, a core principle there to bring up. Anything else you want to add to the Berkshire? It is kind of crazy thinking Warren Buffett is done.
Honestly, I really commend him for choosing to step down, because usually once you are at the top of a mountain in a certain field, you would want, once you leave, everything to crumble behind you just because it further supports your ego. But this is what I think a great leader. And this is a good sign that honestly Berkshire is on the right side of history rather than the wrong side of history.
Totally agree.
It is hard to give up power, and it speaks a lot about his temperament, which made him a great investor.
I think that's a really good point. There was no reason for him. Nobody would have blamed him to stay until he died. And it was, I agree, really cool of him and not shocking at all with the guy that he just seems to be. No ego. Speaking of that, he just seems super humble. And obviously we're just going off of anecdotes from press conferences and whatnot. So like we're
gonna make him blush when he listens to this podcast.
Yeah, he's a listener of the show for sure. So we're gonna make him blush. But it's a really good point for him to go out on top, really, and to be able to step down. It says a lot about him and his character. So, okay. Last thing, again, probably a relatively short topic, but something we wanted to hit that we think is pertinent is the Social Security math not mathing. So a recent report came out. They make a projection every year around Social Security, and this is specifically the Social Security Retirement Trust. So this gets confused a lot, where when people see like these projections on Social Security, I think a lot of times people assume that it's meaning that the whole program is going to be depleted or upended or shut down. That is not what this is referring to. This is specifically referring to the Social Security Retirement Trust. So we'll break this down in a second, but let me just give actually a couple of data points that I think are interesting before we jump into the actual projections here. I just had it. Where is it, Rabih? Here we go. Nope. I just had it. It's on the...
I slacked it too.
No, I have the article. Here we go. We'll do some editing here. Okay, so first we want to jump into just the magnitude of the program of Social Security. So 70 million people receive Social Security benefits this year. 185 million people are working and contributing to the program through payroll taxes. So as a reminder, payroll taxes are what goes towards Social Security benefits. So if you are an employer, you're paying the 6.2%, you're actually paying both sides of it. And if you're like a self-employed individual, let's say, if you're an employee, you're only paying one side of it. So those Social Security taxes go to Social Security. So what the projection is that the most recent report came out is that this program, the trust specifically, will be depleted in 2033 is what they are projecting now. That's actually a year sooner than the most recent projection. So they're saying at 2033, 77% of the benefits in the trust would be payable, which would categorize it as depleted. So I'm going to stop there for a moment, Rabih, and get your just thoughts or response to this.
Yes. I think part of the big confusion about why Social Security trust could be depleted, etc., is because people are looking at it as if it's an investment account. Like, oh, every single paycheck, 6 point something is taken out of my paycheck. And then once I hit retirement, I'm going to be getting that money back. This assumes the framework you're looking from is that it is an account you're funding, and then you're taking the money out of the funding like you do with a 401k or an IRA. This is not what it happens. What's happening is there's one account for the whole country. Every one of us is putting money in it. And those of us who reach age of retirement can start withdrawing out of it. So it's not one person contributing and withdrawing, it's the whole nation contributing and withdrawing. And as the demographic shift changes, you've got more older people than people who are of working age contributing. The amount of money flowing in is going to be much less than the amount of money flowing out. And in that sense, you would say that tank of water is going to get empty in a while. And this is what they mean, that it's going to get depleted.
I'm glad you made that distinction, because it's really confused by a lot of people.
It is confusing. I just pulled up the 2025 federal budget to look at it. We know we're in a deficit, etc. In terms of the source of financing, like the money, the inflow coming in, we got around $2.6 trillion coming from income tax and about $1.7 trillion coming from payroll taxes. Then in the spending, we got a lot of outflows. The Social Security Fund itself is 1.5 trillion on its own, which is 22% of the budget. And then you add Medicare is 1.1 trillion. So you've got, even in the budget, a lot of money going out than money coming in. And when it is interesting, because the first layer of funding is our paychecks, the demographics, whether it is people in the working age, newborns that, have grown up, went to school, joined the working age, or immigrants that have come in, participated in the economy, paying taxes, they're bringing in money. When all of these fail for demographic shift, immigration policy, or just fertility issues where people just do not make enough babies to contribute to the economy, then someone has to step in, because a social security is a promise for the person who have worked all their life funding money in. So who will have to step in that sense? It's the government. And the government, if they do not have the money, they have to borrow to fulfill the promise of a social security. So you could see how this could spiral into something bigger, especially if your second line of defense, the government, is already in a bad financial situation, because now the government has to borrow to pay back debt, borrow to pay the interest on that debt, and borrow to fulfill requirements that its demographic are not able to support anymore. There might be laws that changes the amount that's given out, or change the age at which you are eligible, etc. But those are usually painful and politically unfavorable and cause for disapproval and some people getting upset.
Well, to that point,
it's usually a revolution in other parts of the world, but here we'll just say we'll get upset.
Well, to that point, like I feel like this has to be it'd be political suicide to for anyone who ever tried to say that social, like, it is now ingrained, I think, in the fabric of American
part of the American dream.
It is. Yeah. It is. And one of, if not the most popular piece of legislation that was ever passed back in the 20s, I believe it was the 20s or, yeah, I think it was.
I think FDR did it as part of the New Deal in the 40s.
New Deal. 40s. Okay. One of those decades, a long time ago. So one of the most popular pieces of legislation that was ever passed, and again, political suicide to end the programs, that's just not going to happen. So the question becomes, to your point, if this were to be the case, like, this has to be addressed probably now, very similarly to, and it's funny how this connects to the debt and deficit that we have, but there's a lot of talk around like what moves can be made prior to this happening. Things as simple, but to your point, Rabih, not easy. Things like raising the tax, the actual Social Security tax, things like extending the age that you can start taking it, things like extending out the full retirement age, right, and the max age, all that.
Also, so another one, not adjusting it for inflation immediately. Type of thing.
There you go.
So instead of getting, I remember in 2022, they got like 8% raise on the amount so it tracks inflation. Yeah. In those years, maybe you'd increase it 4%, and then everyone kind of got a 4% haircut without them noticing in real terms.
We've talked about this before, but I feel like maybe we haven't talked about this, but I think we have. Maybe even just off air, just you and me talking. It feels like, to me, it could be something that you could even put something in place for like opt-out and incentivizing like wealthier Americans to opt out later on in their life, meaning opt out of taking the benefit. And and maybe as a benefit to doing that, you give them like a reprieve of capital gains tax of some kind. I don't know how the math would math on that, but I've thought about this, and I'm sure this is not an original thought by me. I'm not a policymaker, but I just think it would be interesting to get creative there and say, I mean, how many Americans are out there that are super wealthy, that are eligible for Social Security, that don't need it, and that you could actually incentivize them with things that would benefit them, like capital gains tax relief, and have them opt out of the program of getting paid out. I think there's things that could come up like that at some point if this gets to be a desperate situation. But one thing I wanted to add, they did a survey. So the National Academy of Social Insurance did a survey of about 2,200 Americans. And of those surveyed, 85% of them said they would rather raise taxes than cut benefits. So one of the most popular kind of policies being floated out there, this is not going to be popular among dentists, but one of the most popular policy options that's out there is eliminating the cap of taxes on earnings over 400,000. So right now there's a cap of the Social Security for wages. Like right now it goes up to 176,100 is the wage cap that is taxed. Then what they're basically saying is a policy that's being thrown out there is that cap would stay in place, and it would actually be a gap from 176 up to 400 grand. And then at $400,000 and above in income, you would then have the Social Security tax turned back on. That's been a policy that's being floated, and it seems like it's gaining a little bit of momentum. So I'm sure dentists don't want to hear that, but that is something that is out there.
That is
Rabih,
interesting.
thoughts on that?
I liked your proposed policy, but I think it contributes to an increasing wealth inequality, because if you opt in to just have your money paid back, between quotations, through capital gains, you can just be aggressive, and you know that you can control kind of your portfolio return. You'll just take more risk. Whereas those who are stuck in a social security program, the amount of return they get is dependent on how much the government is willing to adjust it every single year. And this allows some people to have their portfolio appreciate or their retirement fund appreciate much faster than others, creating more wealth inequality. I don't know. It gets political. Policy is very tricky.
I mean, it's above my pay grade, Rabih. I can throw ideas out on a podcast all day long.
Me too. By the way, I pulled this up just so we are historically accurate for the listeners of this show. You said 20s, I said 40. The Social Security Act was signed into law August 14, 1935. So in between.
So we are both dead wrong.
But it's in between them, in the middle.
Yeah, right in between our guesses.
35.
Sometimes, so 1935. Okay. It was part of the New Deal, though, correct?
I would think so, yes. I can also check that.
Okay, double check us. So we're fact checking ourselves live on air. Okay, well, more to come on that, on the Social Security and really everything else that we covered. Rabih, any other? He's checking the Great New Deal. Was that what it was part of? Yes, we nailed it. We are like historians on this show. Rabih, any final words on anything we've shared today?
No, it's entertaining. I know all of this news takes second, behind what's happening at the Dentist Money Summit, which is not on the podcast, but it's fine. You guys have to just give us this week.
Yeah. Yes. Just give it to us. Okay. Well, Rabih, as always, so fun to do this. And we've yet to miss a show. We're going to keep trying to never miss a show. If we thought about it this week of just like, I got the summit, a lot going on. We're like, no, we're going to do it. So it's always fun to be doing 2 cents with you. If you don't know by now, this show is brought to you by Dentist Advisors. That is our day job. And we would love to talk to you. If you're out there listening and you're thinking, man, I need help with my financial situation. I have questions I want to ask these guys. We are here to help. We love to help dentists. We talk to hundreds of dentists all over the country that just have questions or want to see what it's like to work with us. We would love to talk to you. So you can go to dentistadvisors.com, click on the book free consultation button, and you can talk to one of our very, very friendly advisors. We would love to chat with you. But for now, Rabih, thanks for being here. Everyone, thank you so much for listening. That is our 2 cents. Till next time, bye-bye.